The best time to invest was yesterday. The second best time is today. I know that sounds like a motivational poster, but by the end of this video, you'll understand exactly why the data backs it up, and why waiting for the right moment to invest is one of the most expensive decisions most people in their 20s make without realizing it. In this video, I'm going to show you what the data actually says about timing the market, the 3 situations where waiting genuinely is the right call, and what a complete beginner should actually do with their money today. Let's get into it. Let's start with the case against waiting. And I want to lead with a piece of data that I think is one of the most important things any new investor can understand. If you had invested £10,000 in the S&P 500, that's the index that tracks the 500 largest companies in America, 30 years ago, and just left it alone, you would have around £170,000 today. That's without adding another penny. Just £10,000 sitting and compounding. Now here's where it gets interesting. What if you tried to be smart about it? What if you'd pulled your money out during crashes and put it back in when things looked better? What if you'd missed just the 10 best days in the market over those 30 years? Your £10,000 becomes £78,000 instead of £170,000. You've lost nearly £100,000. Not by investing badly, but by trying to invest cleverly. Missed the 20 best days. £43,000. Now here's the part that makes this really uncomfortable. Those 10 best days don't happen on sunny Tuesdays when everything feels fine. They happen during crashes, during panic, during the exact moments when most people are pulling their money out because the news is telling them the world is ending. The 2008 financial crisis, the 2020 COVID crash, every major downturn, the sharpest recovery days cluster right in the middle of the worst periods. The investor who tried to time the market, who pulled out during the crash, missed those days. The investor who stayed invested, who kept their money in through the fear, caught every single one of them. And here is the inconvenient truth behind every "I'm waiting for the right time to invest" conversation. Nobody, not a single professional fund manager, not a single hedge fund, not a single financial institution in the history of investing, has consistently predicted those days in advance. Not once. The data is unambiguous on this. Now, the other side. Because I said I'd be balanced, and I meant it. There are 3 specific situations where waiting is genuinely the right call. And if any of these apply to you, the rest of this video still matters. But the order of operations changes. Situation 1. You have high interest debt. If you are paying 20% interest on a credit card or a high interest personal loan, putting money into the stock market at a historical average return of 7% is mathematically backwards. Paying off 20% interest debt is a guaranteed 20% return. The stock market offers a historical average of around 7%. Not guaranteed, variable, and dependent on time horizon. When your debt interest rate beats the expected market return, pay the debt first, every time. The rule is simple. If your debt interest rate is higher than 6 or 7%, pay it off before you invest. If it's lower, like a student loan or a low interest mortgage, investing alongside it may make mathematical sense. Situation 2. Your timeline is under 3 years. The stock market can drop 30, 40, even 50% in a short period. It has done this multiple times in living memory. If you need your money back in 2 years for a house deposit, a wedding, or anything with a fixed deadline, you cannot afford to be down 40% when that deadline arrives. Short-term money belongs in a high-interest savings account. We ranked the best 5 in last week's video, link in the description. Long-term money, 5 years or more, belongs in the market. The timeline is the deciding factor. Situation 3. You have no emergency fund. Before you invest a single pound, you need 3 to 6 months of essential expenses sitting in an easy access savings account. Not invested, not locked away, available. Because if your boiler breaks, you lose your job, or any unexpected cost hits, and you have no emergency fund, you will be forced to sell your investments, potentially at a loss, to cover it. 3 to 6 months of expenses in easy access savings, then invest. If none of those 3 situations apply to you, no high interest debt, timeline of 5 years or more, emergency fund in place, then the data is clear. The cost of waiting outweighs the risk of investing. Every month you delay is a month of compounding you never get back. So what should a complete beginner actually do? Practically, today, with real money. The answer for the vast majority of new investors is index funds. An index fund doesn't try to pick winning stocks. It doesn't employ analysts or make predictions. It simply buys a small piece of every company in a given index, like the S&P 500, which tracks the 500 largest US companies, or the FTSE All World, which tracks thousands of companies across the entire global market. When the market goes up, your fund goes up. When the market goes down, your fund goes down. You own a tiny slice of the global economy, and you go wherever it goes. And here's the thing about the market going down. In the entire recorded history of the global stock market, it has always, eventually, recovered. Every crash, every recession, every financial crisis, it has always gone lower, and it has always come back higher. That does not guarantee the future will be the same, but it is the longest-running track record of any asset class in history. Now, the strategy. Because knowing what to invest in is only half the answer. The other half is when. And the answer, which we've already established, is not when the time is right. The answer is something called pound cost averaging, or dollar cost averaging, for the Yanks. Instead of trying to pick the perfect moment, you invest a fixed amount every single month, regardless of what the market is doing. £50 a month, £100 a month, £200 a month, whatever you can consistently commit to. When the market is down, your fixed amount buys more units of the fund. You're getting more for your money. When the market is up, it buys fewer units. Over time, this smooths out your average purchase price and removes the need to time anything at all. The strategy does the work. You just keep showing up every month. It's not about timing the market. It's about time in the market. Where to actually start. 3 platforms worth looking at for index fund investing in the UK: Vanguard, the original index fund company. Low fees, straightforward, excellent for long-term passive investing. Trading 212, commission-free, easy-to-use app. Offers a wide range of index funds inside a stocks and shares ISA. We mentioned them in last week's video on savings accounts. Freetrade, commission-free, app-based, good for beginners. All 3 let you open a stocks and shares ISA, meaning any growth, any dividends, any returns are completely tax-free, up to £20,000 a year. Use the ISA wrapper every time, and you can start with as little as £1 a month. The amount matters far less than the habit. Start small, stay consistent, increase it when you can. The compounding does the rest. Let's recap. Timing the market doesn't work. Even professionals can't do it consistently. Missing just the 10 best days over 30 years cuts your returns by more than half. Waiting makes sense in 3 situations: high interest debt, short timeline, under 3 years, or no emergency fund. If none of those apply to you, start now. For most beginners, index funds inside a stocks and shares ISA are the right starting point. Pound cost average. Invest a fixed amount every month regardless of market conditions. Time in the market beats timing the market. Every time. Links to Vanguard, Trading 212, and Freetrade are in the description below. Also linked, the savings accounts video from last week if you need to build your emergency fund first, and the LISA video if you haven't watched that yet. Subscribe. Next week, I'm covering Buy Now, Pay Later. New government regulations are coming into force later this year that are going to change how BNPL works for millions of UK shoppers. If you use Klarna, ClearPay, or any other BNPL service, you need to know what's changing. Drop a comment below. Are you already investing? Index funds, individual stocks, or still on the sidelines? No judgment. Let's talk about it. See you next week.